Welcome to ODEON Capital Conversations on all things money and markets with Dick BOVE and Matt Van ALSTYNE. And here is your host, John Aidan Byrne.
On this episode, we'll examine two distinctly different views of the American economy. Is it on the road back to rising prosperity, a positive recovery, or is the economy facing an imminent downturn, a year or so or even just months away from a deep recession fueled by soaring consumer and government debt and cash-strapped households? We'll hear from Dick BOVE on Treasury Secretary Janet Yellen's positive posture on the US economy, and from Matt Van ALSTYNE on the multitudes of tailwinds now facing the economy. We'll have more from Dick on the new proposed bank regulations and their potential disinflationary impact. We'll look at China and its vast ghost estates and its housing crisis. We'll pick up on comments by JP Morgan's Jamie Dimon outlining his view of world and domestic events, from the global fiscal debt crisis and recession to China's latest challenges. Dick BOVE is out with a new report on the US money supply. Where are interest rates headed from here? We'll look at that and more. I'm with Dick BOVE, Chief Financial Strategist at ODEON Capital Group, and Matt Van ALSTYNE, ODEON Co-founder and Managing Partner. And we'll be right back after this message.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.
Dick and Matt, welcome for episode 87. We'll have a clearer view of where we're headed on interest rates by next week. We have the Fed meeting this week, and overseas the Bank of England meets on Thursday, Bank of Japan meets. Love to get your opinions, Dick and Matt, on where you see interest rates going, given that the CPI rose 3.7% in August from a year earlier. Now that's a faster pace than July's 3.2%. But core inflation, which takes out the food and energy prices, decelerated to a 4.3% annual rate in August, and that's slower than July's 4.7%. So inflation is slowing. Should we cheer all this news?
Well, I don't accept the core inflation number. I look at the total inflation number because, people are not going to stop driving their cars and stop eating. They're going to continue to do both those things. So my guess is that, inflation is moving up a bit. Oil prices this morning were $95 a barrel. That's a significant jump from where they were, let's say, 6 months ago. We're in a situation where housing prices are going up again. Rents are going up again. I don't see how we can say that inflation is slowing down. I think it's, maintaining itself at an unacceptable rate. And therefore, I think that even though I'm convinced the way everybody else is that the Federal Reserve will take no action tomorrow when it takes a look at interest rates. I do think that the argument that the Fed is going to drop rates 4 times next year, once a quarter, may not hold true. I think that we have got to see inflation come down more. But I think that there are a couple of factors not related to the Fed which are going to cause inflation to come down. Number one, I think that these new bank regulations, which would go into effect starting in January, will be, extremely disinflationary. Already, the Republicans in Congress have sent a note to the bank regulators asking them to completely eliminate all of these regulations. There are a number of Democrats that are against these regulations. There's been quite a bit of noise saying that these regulations should not go further. And as we've said, in prior, two prior podcasts, we think that these regulations will cause the banks to lend less money, which will have a depressing effect on the growth in the economy and a depressing effect on inflation. So I don't see any loosening up occurring at the Fed level at the moment. Whether they're at the peak or not, I think is another question. I think we are at the peak or pretty close to the peak, but it doesn't mean to say that they're going to come down as fast as people hope. The expectation is that within 4 or 5 months, interest rates will start to be cut. I don't see that happening at all.
Well, we'll come back to the banks in a moment, Dick, because you have a report out also on Jamie Dimon, or your insights, as it were, because Jamie spoke last week at an investor conference. I was listening to Janet Yellen on Morning Joe this morning, and I was taken aback somewhat. She said the consumer is feeling much better. We've had a remarkable recovery. And she said that while consumers are feeling better, they don't feel good about the economy. I just thought it was very disjointed what she was saying, and perhaps even misleading, because the conference board last month, as an example, said consumer confidence tumbled to 106.1 in August from a revised 114 in July. And consumers are really feeling the pain on credit card debt. Balances are higher, interest rates of above 20%, 30-year fixed mortgage above 7%, prices at the grocery store, gas prices. So what do you make of all of that?
I mean, as I've been noting, Janet Yellen now has a different responsibility. Her responsibility is to get the president reelected, right? That's the first responsibility. And the second responsibility is to keep the government open. And in order to do both of those things, she has to take a very positive approach to where the economy is going. And in, I guess, the comments on CNBC yesterday, and I guess what you heard this morning on Morning Joe, basically she's doing what she's supposed to do. She's saying that the consumer is in great shape. The consumer is feeling fine. The consumer is going to spend more money. The consumer is going to drive the economy higher. Everything is looking good. And she's trying to, give confidence to the listeners that they should go out and spend money and take, steps to assist the growth in the economy. Her second responsibility is, supposedly in 10 days, the Congress has to take another vote as to whether to keep the, and I don't understand, I thought it was November, but, I heard on television this morning, it's in 10 days, and both the Republicans under Kevin McCarthy, and I'm going to say the Democrats under Janet Yellen at this point are laying out their cases. Janet Yellen is basically saying, you don't have to do anything. We're going in the right direction. McCarthy is saying, we've got a lot that has to be done. These are the things that have to be cut from the budget. This is what we've got to do about immigration. And so the clash has been set up. Both sides have indicated their positions. And now, the rest of the people in the Congress have to determine where they want to be and which side they're going to be on. So generally speaking, I think that it's very difficult to believe anything that comes out of the mouths of anybody who is in Washington, because they now have major political agendas. They've got to get their candidate elected president in November of next year. And that doesn't start by, yelling and screaming in July and August. You start yelling and screaming now, which is what they're doing. It's going to be really interesting to see what happens in the next 10 days, how this vote is going to run to see whether they are going to shut down the government or not. There is a real chance that they will.
When you say they're going to shut down the government, it's not a proactive decision. I mean, I guess you can make an argument that the Democrats and Biden would be the beneficiaries of the non-proactive decision, but it seems like there's a handful of Republicans in the Republican-led House, that are hell-bent on causing chaos. And that seems to benefit the Democrat Party. And, Sun Tzu always said, don't get involved when your enemy is making a mistake. And that's what the Democrats' plan is to do, is to let the Republicans make this mistake. But from our perspective, the hit to the economy could be, catastrophic. And we have a lot of tailwinds, and then there's storm clouds on the horizon. I mean, look at the tailwinds we have. You have the UAW strike, which, it's been decades since we've had like a strike like this, where the sides are really far apart. And you listen to the head of the UAW talk, and he talks about how they want a 40% pay raise to match the management's pay increases since their last deal. And you're like, huh. Okay, that makes sense. I understand the logic. Management's made 40% since we signed a new deal. We should make 40%. But then if you do the math, if they give pay raises of 40%, and we're talking about companies that are trying to transition under the government mandates to more EVs, they do not have the price the cost advantages that Tesla has. Tesla is able to roll out EVs on a profitable basis. All of Detroit loses money when they sell EVs, and they're subsidizing it through their gas-powered vehicles. And so it's a very intractable position. If the UAW gets close to what they want, it'll just put more pressure on the car companies. Combine that with what's going on in the White House, in Congress with the government shutdown. Last year, I don't know if anyone kind of remembers, but at this point in time last year, I was harping on about how the coming winter could be a game changer to Ukraine and to Europe, because Europe doesn't have enough energy. And they had the warmest winter, I think, since modern records had ever been kept, and the energy crisis, never came to be. But this year is totally different. And if you look at what MBS has been doing in Saudi Arabia, he's been doing cuts. A lot of the China hawks have been getting nervous because China's been hoarding oil this entire summer. They've been buying more oil and filling up their reserves, while, by the way, America has been draining our reserves. And people, China hawks have been saying, oh, they're getting ready to invade Taiwan. Well, what if it's something different? What if they know that this coming winter there's going to be more cuts to oil, and they're just getting ready so that they have enough oil supplies to get through the winter, and this is a design to choke off the West. Like, there's a lot of headwinds on this economy, and it's unbelievable to me that the Fed's even considering raising rates, because to me it seems to be that this is not a monetary inflation. I know we talk about M3 a lot, and I think Dick and I disagree a bit on this, but I think it's a supply chain cost inflation, and we need to get to a spot where we're no longer printing money to fight this war in Ukraine, and we're actually worrying about our own house. I feel like there's a lot of headwinds on the economy, and the thing that scares me the most right now is it seems like the consensus among economists, or at least public-facing economists and popular ones, is that we're going from a soft landing to no landing, which is they kind of think there's no recession. And, one of Farrell's top 10 rules of investing on Wall Street is when everyone agrees something's going to happen, that's when you know that something else will happen. And right now it feels like everyone's kind of is shaking hands like, hey, we did it. We're not going to have a recession. And I'm with Dick. I think the only difference I have with him, I think you're saying for a recession in the middle of 2024, is I think it's going to come Q4 or Q1.
I hear you saying there, Matt, repeating a theme that has come up constantly on episodes with Dick's research: debt, more debt, and debt. Again, if we do have this soft landing or hard landing or crash, it's going to be severe because it's debt fueled, and that's one of the biggest headwinds we clearly face. On top of a nation that's at strike, and homeowners pinched in the pocketbook when they go to the grocery store. It's very difficult to see where this is going to play out. And so do you think this could be the end of interest rates if things head suddenly in the wrong direction, if they head south?
But yeah, if we get into a recession, it's unlikely that the Fed is going to increase interest rates. I mean, I think the Fed is not going to sit there and say, we're going to be so pedantic about, raising rates that when nothing's going to change our mind. I think that, for example, if what Matt said is correct, or we get it in the fourth quarter of this year or the first quarter of next year, the Fed will definitely back off. I don't have any question in my mind about that. It's just that, I rather not think about the Fed anymore. I'd rather think about what Matt was saying, and where are we really going with this economy? And as I see it, and you said this a moment ago, John, but I think that the consumer is getting stretched. I think the debt load is now increased. The cost of that debt load is higher than it was before they even started growing that debt load. that has to be a factor in what they're thinking about in terms of how they're going to spend money. So I think Janet Yellen's view is totally incorrect. I don't think the consumer feels good. I don't think the consumer is going to go out there and spend a lot more money. We're already seeing a change in the spending habits. In other words, money, I think they now call it, are you spending the money on necessities or experience? Experience meaning you're going to take a trip, or you're going to go to the movies, and apparently the spending patterns are going back to necessities away from experience, all of which would suggest that the consumer is feeling the pressure and that we are headed for, a difficulty on that side. And I think the view that the economy has absorbed or already corrected for the increase in interest rates is just totally incorrect. I just don't believe that the economy has yet got enough time of paying debt service costs, whether it's a corporation, the United States government, or the consumer, to feel that we don't care where interest rates are going to be. We do care, and we do care about the amount of debt, and both of them are too high, and very hard to see how we're going to do really well in that situation.
Are we isolated in any way from China's downturn? Should we be worried about it? We've talked about what could happen in the US domestic economy, where the Fed may move on interest rates and the consumer being pinched. But we keep getting reports every day, the latest being that China's economy faces even a bigger housing crisis, quoting here from the Wall Street Journal. 2 years after Evergrande's fall, distressed property giant Country Garden threatens to create worse problems. Its financial distress could create far bigger problems for the economy and policymakers than Evergrande's debt defaults did in 2021. Okay, so is that just a China situation? If China just really plunges further, does it have ripple effects beyond China because it manufactures our goods at a cheaper cost than we can?
Well, yeah, of course it does, because and I guess that other country, Countrywide or whatever his name is, I understand they missed the debt payment this morning, which is putting them in default. But we export a lot of goods to China. I mean, we import more than we export, but we still export a lot of goods to China. And if China's economy weakens dramatically, then we're going to export fewer goods. However, I'm not aware of any recession in this country that's been created because of a decline in exports. I think they're all declined. The recessions are all driven by internal events in the U.S. economy. So while if China, goes into deep dive at the moment, it'll hurt us, but it won't put us into a recession.
I completely agree. I don't think China will impact. This is not the situation of when China catches a flu, America gets a cold. I think it's more of does it destabilize the region? Does it destabilize Xi internally? The story we've been told, at least in the West, or what I've heard, is the Chinese populations are kind of controlled through this compromise, which is, hey, let us be in charge and everyone will get rich. And if that starts changing, where you have one party control and people are not getting rich, in fact, their savings, which was, plowed into, and it wasn't Countrywide, Dick, it was a Country Garden. Countrywide is the U.S. one that went down in 2008. Country Garden, which is, some of these images of the towns that Country Garden has built are just spectacular. They look like these Manhattan-sized lines and lines and lines of apartment buildings. And what you're told is that these apartment buildings, some of them are 30 and 40 stories tall, and there's 10 or 15 of them in a row with the parking garages and all that, is they built the shell, but internally they have no, parts to complete the housing. And, the average Chinese person put $200,000 down on an apartment, which they believed would be built, and then they'd be able to flip it for $300,000 or $400,000. And it was this rolling, scheme that was kind of working for everyone. And now the companies don't have the money to finish the apartments. The apartments are worthless without being completed. And so the savings of the average citizens are going to be stuck in these ghost towns, and they're not ever going to be able to get their money back. And so the feedback loop that that is explained to me is the citizenry gets restless and Xi becomes unstable, and maybe he has to do something external like invade Taiwan or launch a trade war or do a some sort of internal crackdown, and that it's destabilized into the world and destabilized into the region. But that shouldn't necessarily impact us economically, except for the extent that we all do better when everyone is doing well, and a rising tide lifting all boats is actually lifting all boats.
In the case of Country Garden, they were building a lot of houses in rural areas. And so, coincidentally with that, a lot of the rural population is moving into the cities. So there's two things hitting up against each other. There's no buyers as well. That's one of the issues.
What China was trying to do was to create areas of economic growth outside of the main population centers. They wanted to diffuse the movement of all these people to, Guangzhou, Beijing, what have you. And essentially that's why they built these cities that can handle, as many as 10 million people in areas which are diverse from the center of manufacturing activity in the country. So they had a viable strategy. The fact is that they never considered the fact that the people wouldn't have enough money to buy these apartments in these places, and these companies would not want to move their production to areas where the transportation lines were longer, where the supply lines were more expensive, etc. So now they have to deal with the fact that these shells are up there standing and there's nobody in them, and the people who have invested in them are going to lose their money, and it's going to have an impact on the economy. Now, I remember a long, long time ago, I had and I've mentioned this before, I had, lunch with the CEO of Citigroup, and he was saying, Dick, he said, there are 65,000 riots that occur in China every year. I said, how the hell do you know that? He said, well, there's some organization that counts when there's, an announcement of 3 or more people that are demonstrating against the government, and that these people in China are demonstrating all the time against the government. And the fact is, the only way you keep them cool and calm is to give them food, a place to live, and some recreation. And, China's reaching the point where they can't do that. And if they can't do that, then, it's going to be 65,000 individual groups of 3 people or more, having, riots or what have you. I don't know. But the fact of the matter is there will be a tremendous amount of discontent. And China is in trouble, outside the country also, because it put out this map in which it showed it controlled all of the, I think it's 200 nautical miles from the shore, and therefore they're grabbing land from the Philippines, from Japan, from Vietnam, from Singapore, from Malaysia, from, Indonesia, from obviously Taiwan, from Korea, and everyone from Russia, actually, also. Every one of these countries have objected. They've sent their patrol boats. They've got all, as Matt explained before, they're not big boats, they're small boats in their Navy, but they send them all over the South China Sea to enforce the fact that they own this land. So they've created this enormous amount of anger against the country among all their neighbors. And then, of course, because it's now time for other countries as far away as Latin America to pay their debts on the Belt and Road obligations, and they can't pay the debts. And therefore, that's creating some upset. In fact, countries like Argentina are going to the IMF, asking the IMF to lend them money so they can pay the interest on the Chinese debt. And I don't know how long the IMF is going to be, willing to do anything of that nature. So China has got problems maybe with its internal population. It's got problems on its immediate borders. It's got problems with the payments that, they're demanding from the Belt and Road situation. So I'm happy it's happening because I'm an American and I believe they're our enemy. But the point is, it is happening, and it's not going to be good for China for a while.
Maybe want to de-emphasize the word enemy. I mean, the Chinese are our friends also. We do business and commerce with them. We want a peaceful China and mutual cooperation. The Wall Street Journal had a report out on Saturday, and this speaks to something you brought up many months ago, and I think Matt might have been skeptical of your assessment here, Dick. So maybe you need to take a bow here. China and Russia outrun US in race for hypersonic missiles. Subhead: superfast weapons can evade most air defenses. Hypersonic missiles.
Yeah, well, I think, that and quantum computing are the two areas which are most frightening, because they basically have missiles that we can't stop. That's obviously a huge problem. And what makes these missiles even worse is that they can carry multiple warheads, which means that, they can send a missile toward, we'll say, the east coast of the United States and hit Boston, New York, and Washington with the same missile, because they can have these offshoots to the missile. How it works exactly, I don't know, but basically that's what I'm being told. But the quantum computer thing is worse, because apparently quantum computers come from a totally different standpoint in physics, and they can read. They're so fast and they're so powerful. They can read, the standard computer. All right. And the net effect is the United States and China are rushing to see who's going to get their quantum computing set first. But it's another huge threat to where we stand. So yeah, I know the word enemy is very harsh, but I believe there are enemies. Okay. I therefore believe that we need to protect ourselves against them. But I also believe that you are correct, that it is far better if we can find some, peaceful, method to continue to work together, to do trade with each other, to grow our two countries together. I just don't think China is willing to do it.
I mean, there's a difference between enemy and competitor, and we can get lost in the semantics of it. I just think that, going along the lines of, first off, the hypersonic missiles, I would kind of take dispute that I disagreed that you were right on that. The two issues I have with it is, I think it's entirely possible, if not probable, that we have the technology. We just haven't gotten caught using it, and it's better for us geopolitically to keep it a secret. Maybe that's just my bias, but it just seems like the type of thing that maybe would be happening when, countries that we would consider behind us technologically have seemingly more advanced weaponry. Well, I just want to check your assumptions at the gate on that one. The second thing, though, on the supercomputers, it was kind of off the radar as Trump was leaving office, but he banned exports of certain chips to China, and then Biden, when he got in office, expanded the ban, and the whole idea was to prevent Huawei from developing the highest tech 5G phones and potentially going into 6G phones. Because they don't have the chip manufacturing capacity. And, the new phones that just came out from Apple the other day, they have what are sized as 4 nanometer chips. Like the smaller the number, the better, the more high powered the chip. And the belief and expectation was China was stuck somewhere around 15 or 20 nanometer chips. And so they would never be able to get there. And, 2 weeks ago, when Janet Yellen went over to China, as she was meeting with the leaders over there, Huawei introduced a new phone called the Huawei Mate 60 Pro. Maybe it's Mate, I don't know. And it is powered by a 7 nanometer chip. And the word on the street, according to the Wall Street Journal, is that the intelligence analysts that follow this are just stunned. They're floored. They're beyond shocked that China, on their own, developed a 7 nanometer chip when we thought that they were stuck in the high teens in terms of size, and that the growth and progress from where they were to where they are today, they suggested that it could only be achieved through espionage and stealing American technology. But regardless of whether it was stolen or not, they do have the capacity to make their own chips, which again goes along with what you're saying, is if they can get down to 4 or 3 nanometer chips, that they would have the potential to power a quantum supercomputer, and that quantum supercomputers are basically can break into any of the old computers that we all rely on and use on. And so the only way you can defend against quantum computing is to have quantum computing yourself. My sanguine attitude towards the hypersonic missiles is, what's their purpose? Okay. They can take out an aircraft carrier fleet before the aircraft carrier fleet knows. Okay. But that's the same as a submarine taking out our aircraft carrier fleet. It's the same as taking out Washington D.C. with a hypersonic missile is the same as taking out Washington D.C. with a nuclear missile. Like if that's where we are in terms of relationship, is we're blowing up each other's cities and blowing up each other's aircraft carriers, we're already well into a world war, or it's a sneak attack that leads to a world war, which leads to mutually assured destruction. And so there's a part of me that kind of thinks, so what? Like they can't use that not without knowing that the retaliation will be the end of civilization. And so it kind of, it's like a doomsday machine that's like, okay, you have it, but I can't, it's just hard to imagine a scenario where they would be comfortable using it because the retaliation would be so severe.
I think you're right. It's all threat, as opposed to going back to your Sun Tzu, it's all, threat and posturing as opposed to the reality that they're going to use them, but they have them. Hopefully you're right that we have them and we're just not building them yet, or we're building them and we're not telling anybody about it, but they have them and it is a threat. And the way they're trying to moderate the threat is by saying we're going to use them on a limited basis in a place like Ukraine. And we'll see if they try to do something like that.
Speaking of China, you parsed Jamie Dimon's recent comments, Dick, to investors, and he has broad and sweeping and some very specific statements. He brings up the geopolitical situation, the domestic economy, and he brought up China. We could start at that and look at the other areas too. He went on a trip to China recently. Jamie Dimon runs one of the world's largest banks, and he said that a lot of folks in Asia, these are his words, think that America wants to, quote unquote, contain and maybe hurt China, which I don't think is true, according to Dimon. I'm quoting now from Jamie Dimon. But I think the American government has been quite clear that it isn't the goal. Their goal is to protect US national security, American competitiveness, and hopefully they'll be done in a way that's fair and reasonable with our allies. So the Chinese people are worried about China. He was speaking extemporaneously, as they said, without notes, obviously, because he was all over the map, but it was really interesting. He talks about possible recession, the terrible global fiscal debt crisis, and then he talks about our fiscal spending. Then he lashes into regulators on banking regulation. He really hits at them, describes it as a total disaster, the banking regulation. So summing up, he got in a lot of important pointers there, Dick.
Well, that's what's kind of fascinating about when he spoke in New York last week, and that is he seemed to want to talk about these broad issues, but the conference that he was speaking at, they wanted him to talk about how is JP Morgan Chase doing right now, how they're trading, how it's investment banking doing. So the questioner would ask him a question about, A, and he would immediately diverge to B. But the reason why I put out the report that I did, quoting him, meaningfully, is because he's saying what we're saying. That's what struck me about.
I think he must listen to ODEON Capital Conversations podcast.
Anyway, I doubt it. But the point is that he came to his theories and we came to our theories. They're the same. In other words, he was very, very concerned about the fact that the world has changed. He called it a tectonic change. I think that's like a volcano or something of that nature change, that the world is never going to go back to the way it was before, and that it's due to the fact that this separation has now occurred between the major economies of the world, and that we have to prepare for that. In terms of his position in China, a decade, maybe 2 decades ago, China was supposed to be a major opportunity area for JP Morgan Chase, and by the way, a whole bunch of other banks. But the fact of the matter is, after, they taught the Chinese how to do all the things necessary to raise capital in the world economy, they were pushed out. And I think the latest thing that JP Morgan Chase has done in China is move back to, Hong Kong, and Morgan Stanley is kind of moving out of the area. Citigroup, indicated, that they're leaving the area. What he's saying and what we've said are the same. The world is changed in a fashion that is so dramatic that we're not going to go back to what it was after 1991 when the Soviet Union was split apart. And that's going to mean that the price of goods are going to be more. It's going to mean that the flow of funds are going to be more constrained. It's going to mean that, each country has got to look to its own resources to a greater degree in the past. And that's his theory. That's my theory. And I think that's what's happening. Now, what he's also saying is we can't let that happen. We've got to think about ways to become friendlier, to cooperate, to work together in a positive fashion, because, it's not, the direction we're going in is not good and it's not right. I wrote him a note, asking him to speak with us more directly, which he has not responded to. But the point is that he has the same view. Matt would love his view on United States debt. He believes that it's out of control, that it has to be controlled, that we cannot have a situation where the debt continues to grow at an uncontrolled basis, that it's going to have a very negative impact on the economy. He said that people think that inflation's under control, but we could have oil at $150 a barrel in the middle of next year. He said that we could be in a situation where the yield on the 10-year is well above 5%, as opposed to, everybody being all upset about it just cracked above 4%. So the net effect is he's thinking the same thing about money availability. He doesn't believe that inflation has been beaten, which is what we say. We don't believe it has been beaten. He believes that there is a serious global debt crisis, which is what Matt has been the lead on that, but we both believe in that situation. He is not, he didn't say we're going to have a recession next year. What he said was, everybody thinks the consumer is going to keep spending and spending and spending. And as we said last week, he said, the consumer is spending like a drunken sailor. He got this huge amount of money from the government and he just keeps spending it and he's borrowing against it. And he's saying that anybody who thinks that that's going to continue better stop thinking that. That they've got to show more caution. And he used the word caution about the economy maybe 4 or 5 times. He just kept saying it repeatedly. And again, that's what we're saying. So the banking regulation thing, we wrote a report saying we entitled it Killing the Banks, because we thought that the regulation would dramatically harm the banks. He is far more explicit on that subject than we are, far more, visceral, because he's a bank and we're not a bank, but we're a beneficiary of killing the banks. So the bottom line, though, is there is no difference in opinion there either. I was just amazed as I sat and listened to him, because he ticked off one after the other, all of the things that we've been talking about, and he's on the same side as we are in every one of those issues. So I don't know, when someone who's a hell of a lot smarter than I am tells me that he agrees with the stuff we're saying, it makes you feel a lot better about it.
Yeah, he really took the regulators to task on bank regulation and asked, do they want banks never to fail? I never thought that was the goal, according to Dimon. He also had a very interesting stat. I'm quoting now from Jamie Dimon. I look at this major issue today about what we've gone from in America, and this is in your report, quoting from Jamie Dimon. We've gone from, in America, in 1996, 7,300 public companies to something like 4,500 today. It should have gone from 7,300 to 14,000 with the growth, the economy growth. Private equity, meanwhile, has gone from 1,000 companies to 10,000 companies. What's going on? He's asking.
Well, it's the movement of technology and scale. In other words, as companies, how do I say this? As technology continues to improve, it tends to get very expensive, and therefore only the biggest companies can afford to use the most advanced technology, because they may have the money to go out and buy all the computers and put in all the systems, but if they don't have enough unit sales to go through the factory that they've created, I like to call it a factory, but it's a huge number of computers. If they don't have enough transactions to go through that factory, they can't afford the factory. And therefore, you've got this consolidation. That's one thing. The other thing he's talking about is that when we had this massive increase in the growth of money supply, and it came, and the money cost virtually nothing, that, private equity firms, grew. They were able to get control of this money supply, and they're buying off all the companies that, he thinks should have remained public. And of course, when they do that, we no longer have transparency on what those companies are doing, because private companies don't have to report anything to anyone other than the IRS. At the end of the year, they got to pay their taxes. He's bemoaning the fact that, private equity companies are getting greater and greater control of these companies, private companies, number one. And number two, he's bemoaning the fact that, he doesn't want to see his competition go away. He wants to see all these small banks stay in business. He wants to beat them, but he doesn't want them to go away. And I think that's what he's talking about there. He's talking about, we're not allowing small business to grow. We're keeping small business under a cloak because they're owned by private equity firms. And that's not, from his perspective, I think, now I'm assuming that's not good, right? Otherwise he wouldn't have brought it up.
I kind of want to channel my view of what I think Jamie is actually thinking or saying. And maybe it's just my interpretation of how I see the world. But, when you distinguish successful countries from unsuccessful countries, one of the main things that differentiates them is abiding by the rule of law. The government, through elected people or maybe input through dictators or whoever, they set up the rules, and the rules, fit on these pages of paper, and we all follow them. And as long as we all follow the rules, we all know the way the game's going to be played, then the systems will work. And one of the things that we set up was the FDIC. And the FDIC is this federally deposit insurance company that basically charges all banks a small fee, so that if some banks get into trouble, the depositors have confidence that their deposits up to $250,000 will be protected. And when Silicon Valley Bank got bailed out, contrary to the rules, in great excess of the amounts of money that would be needed to pay to bail out Silicon Valley Bank according to the rules, and they decided, we're going to save everyone. Not only are we going to save everyone, we're going to save everyone at First Republic. We're going to save everyone at Signature Bank. And all of a sudden, the rules got changed. And so when Dick was out there just a few minutes ago saying, asking rhetorically, or maybe it was you, John, like, is the design of the banking system that no bank will ever fail ever again? Well, if that's the system we're now operating under, then yes, they have to change the rules dramatically, because the insurance system isn't rich enough to support no bank can ever fail. The only way they can make that work is to make sure that banks don't ever take risk. And if the banks never take risk, then banks will never fail. Therefore, the FDIC system works. And I think what Jamie Dimon is actually pushing for is just a return to regular order. Like, let banks fail. Let the FDIC system work. Let the system, churn out and get rid of the bad actors and reward the good actors. And Jamie Dimon, I think, views his bank as a well-run bank. I do have some issues that they are one of the strategically safe banks. It's too big to fail. I feel like we should get rid of that designation and let all banks be subject to failure. But I think what he's really bemoaning is the disregard for the rules. We've set up a system that has worked, and it works to make everyone richer, and it works to make businesses take risks and get capital to take risks and hire employees and develop neighborhoods and develop communities. And when you get rid of the guardrails and just say, instead of getting rid of the guardrails, you build giant guardrails so that no one ever takes risks anymore, you're choking off the lifeblood of the economy. And it's not good for society. And I don't think it's good for the banking system that basically every bank is now too good to fail, because the regulators now have the mindset that we can't let banks get to a point where they might fail. And it's causing these rules and regulations that are going to be crimping bank success in the future.
Well, based upon what he said, I think he agrees 100% with what you just said, because he believes that banks should be allowed to fail. And he does not believe that the system should be set up to bail out everyone, everywhere, all the time. But where, I diverge from what he's saying is that he believes that that the government doesn't know what it's doing at the moment. And I think the government does know what it's doing. What the government says is, we can't support the system that is now in place. So we got to do something to change it because, and again, you just said this, but if we're supposed to guarantee everything for everyone, we don't have the money to do it. And therefore, we're going to do something to make sure that the system changes so we don't have to do that. And what these banking rules say, and the reason why I wrote this thing entitled Killing the Banks, is because that's the theory behind what they're doing. They've got to allow these banks to fail. They've got to allow, people who put money in these banks at $1 million, $2 million, $5 million, they've got to have risk in that money. That money has got to be at risk to them losing every dime of it, and these regulations are moving in that direction. These regulations, which I think are necessary, are moving in the direction of saying, you got to have risk. You got to take, these loans out of the banks. You got to put them in the private sector where we're not guaranteeing them. You got to have risk. So he agrees, you agree, I agree that you got to have risk in the system. The difference between what you and I believe and what he believes is, don't touch me. Okay. Because I'm a big bank and leave me alone. Okay. But that's the only difference, I think, in our theory.
I guess I'm trying to understand and learn a little here, Dick. So you could have an employer with a massive payroll, several hundred, several thousand. They could at any one point have multiple millions in their bank, and most of that is uninsured. Am I correct in that? Obviously,
yeah.
am.
Yeah. Obviously, yeah. I mean, what do you think? General Motors is going to put $250,000 in a bank? They have to have money in banks all around the world because they sell cars all around the world. They buy products from companies all around the world to make their cars, right? So they need to have millions of dollars in these banks everywhere. Okay, now that's where Citigroup has its major advantage because they're all around the world and they allow General Motors to do that. But the point is, the American public should not guarantee General Motors deposits in all these banks in the United States. And that's what we've come to. And it's absolutely wrong. It just shouldn't happen because, number one, we can't do it. Number two, the taxpayer should not be put under this risk. They don't control General Motors. They can't tell General Motors what to do. So General Motors has got to be at risk of failure. Now, President Obama bailed them out when they failed, in his period, and everybody thinks that was a wonderful thing to happen, but maybe it wasn't a wonderful thing to happen because, the bottom line is if you don't put risk into a company, that company is going to make tremendous mistakes in its operations. And what we've done with the president saying every dime in banks in the United States is protected, the Secretary of the Treasury is saying every dime is protected. What we've done is we've taken risk out of the banking system, and that is a terrible error. What these new banking rules do is they put risk back in the banking system. And that is the right thing to do, even though, as they say, if you're the head of a bank, you may not agree with it. I think it's the right thing to do.
I think your number, Dick, was in or around 40% of deposits in US banks were uninsured. That's a number I read recently, over 7 trillion out of maybe a total of 18 or 19 trillion. And we had a lot of listeners pay attention to your analysis on the regulations on the last episode. And I just had a follow up on that because deposits are not sort of going away per se, even though they're scaling down because people are spending all that money that built up during COVID. It's more an accounting thing as such. The banks are going to create more long-term debt, get out of risky activities, but those actual deposits that customers have, they're not going away. It'll just be a whole different accounting methodology in a sense, so that the regulators won't be on the hook for any massive losses that may happen.
Yeah, right. In other words, the money doesn't go away. It's just no longer deposits. If the bank says, I'll give you, 2.5%, if you give me your deposits on a, 5-year CD, or I'll give you 5.5%, if you buy one of our 5-year bonds, 5-year term bonds, what are you going to do? You're going to take the 5% and buy the bond, right? So the net effect is once you do that, the deposit money is now become a loan to the bank through the purchase of debt, and the government doesn't have to worry about that. They're not guaranteeing that. They don't guarantee anybody who buys the debt of a bank. They don't guarantee anybody who makes an equity investment in a bank, which, and Matt is right, you can't. That's what they did at Silicon Valley. They should never, ever have done that. They should have let that bank go down, all right? And they should have never let, First Republic get bought by Jamie Dimon at such a cheap price, or First Citizens by, the Silicon Valley Bank stuff at such a cheap price that they're now making a fortune.
Do you know, Dick, how much the uninsured depositors at Silicon Valley Bank would have lost had it failed, and ignoring timing? But is it like 10 cents on the dollar, 5 cents on the dollar? Like it's not anywhere close to 100 cents on the dollar, correct?
No, but it is closer to 80% on the dollar. I mean, if
they would lose 80%, or
I mean, the big ticket depositors, they would have lost everything because they weren't insured, and the government paid.
No, but when in other banks that have been allowed to fail, the uninsured depositors don't lose everything. They just lose the difference between the assets of the bank and the deposits on the bank. And I think my memory on Silicon Valley, I thought it was more like 5 or 10%, on the uninsured deposits.
Yeah, well, because A, the government guaranteed them, and B, First Citizens was willing to take them over, even though they were uninsured deposits, and keep the deposits. Citizens was guaranteed on them.
Yeah, but ignoring the guarantee, if you had just gone through regular order liquidation, the depositors would have gotten more than 0 cents on the dollar back.
Right.
And I think it was closer to 80 or 90 cents. And so I guess I'm hypothesizing, because the issue on that one was they failed basically late on a Friday, and payroll was Monday. And a lot of companies, like John had mentioned, had made big deposits on that Friday in anticipation of processing payroll on Monday. Had they failed over the weekend, payroll wouldn't have gotten processed, and that would have led to lots of Silicon Valley companies unable to meet their payroll. And I just wonder if they could have come to a better solution where it was, threading the needle, saying, hey, you're not gonna get full bailout, but we'll front you 80 or 90 cents on the dollar. That should help you get through your payroll, and we'll front you a little bit, and then we're going to let this bank fail like in normal course, but we're going to help process the payrolls and actually address the actual issue that they're trying to solve, rather than just give a handout to the Silicon Valley Bank and their acquirer.
Yeah, well, you see, the point is that if the reason why banks always fail on a Friday is because the government needs Saturday and Sunday to shift over, for the failure, and the bank can open up on Monday under, the FDIC's control. Therefore, those payrolls would have been met by the FDIC, because they now control and own the bank, right? But the point is that, they were fortunate enough to get First Citizens to step in and take it up, and they met whatever was required, with the government saying, don't worry, First Citizens, if you lose any money, we'll cover you for the money you lose. But if you don't, if you take this thing over and run it and you make money, then you keep the money you make. That's the deal that was made. And First Citizens, First Citizens stock took off like a rocket, because of that understanding. You can't run an effective capitalist system if you just are unwilling to let things go under. They have to,
and you're picking winners. I mean, this is the same with UBS and Credit Suisse, where the government comes in and is like, hey, we're going to force you to do something. And then the acquirer, I guess, if you're in the lucky spot to be in that position, says, oh no, please don't do that to me. This is so expensive. Can you please give me this type of guarantees, or can you please help me on this? And then, 3 months goes by and they have record profits because they get to write up all the assets that were forced upon them.
Yeah, I mean, that's what happens in the United States also. Basically, the acquirer marks down the value of the loans to, let's say, 60 cents on the dollar. Then they acquire the bank at those values. Then once they own those loans, they say, oh, wait a minute, these are good loans. And they mark them up from 60 cents back to 100 cents on the dollar. They show that as a profit, which is exactly what UBS did in the Credit Suisse situation. And then they say, well, look, we did this, we bailed you out, and we made this huge amount of money. And, isn't that wonderful the system works?
Isn't that wonderful that our government's picking winners and losers? Yeah, I share Jamie Dimon's frustration.
Dick, you've a new report out on the US money supply, and its headline, the Federal Reserve continues to report false money numbers. ODEON Capital Group's new revised M3 definition corrects these errors. My question for you is, will the Fed ever change its methodology now that you have shown them to be producing these false numbers that I think are hurting and damaging the economy, frankly?
Yeah, well, basically, the Fed does change. It keeps changing the definition of money. But, before Matt jumps at me on this one, let me explain to you why they do it.
Wow.
Why they do it.
No, start exercising.
No, but in other words, the question that you always ask when I talk about this is why do they do that in the way they're doing it? In other words, why won't they count more than $100,000 as money? Why won't they count money in the money market funds as money? And the reasoning from the Fed side, if I understand it properly, is they think that money is transaction money. Transaction money is money which you can put your hand in your pocket, pull out a $50 bill. That's transaction money. You can go to the bank, and in that demand deposit, you can pull out whatever amount you want, and that's transaction money. If you have a retail money market fund, you can pull it out, and that's transaction money. If it's more than 100,000, it could be wrapped up in a CD, and you can't pull it out immediately without paying a fee. If it's an institutional money market fund, it could be that you're going to pay some type of fee to pull your money out before the maturity date. So the government is saying, if you don't have immediate access to that money to make a purchase exactly at the moment you want to make that purchase, we don't want to count it as money. My view is that the fallacy in that philosophy is that if you have $150,000 in the bank, you can take it out whenever you want. So it has to be considered to be money. If you have money in an institutional money market fund and your General Motors, and you call up Fidelity and say, I want, $10 million in 15 minutes, Fidelity will give it to them in 15 million. They're not going to make General Motors pay some unusual fee to take the money out. So I believe that if the money exists in a place where you can get it, it's money. And therefore it should be counted as money. Up until the rapid rise in interest rate, it was a theoretical argument, right? Who cared whether it was transaction money or savings money? Once interest rates went up very rapidly and money started moving out of the banks and into these other places, then, you run into a problem, because basically, the transaction money is still transaction money, even if it's in a money market fund as opposed to, a bank, and even if it's 300,000 instead of 250,000. So, the money supply number that we've constructed at ODEON takes into account where money is, how fast you can get at it. If it's fungible in, less than a day, in my view, it's fungible and it's money. The Fed's view is different.
I don't think I'm going to jump on you for that. I've understood it. I think where I jump is some of these times when you hear the government change their definitions or change the metrics, like when the CPI was changed to switch to imputed rent versus actual housing payments, or something like this where they change M3 and M2. It's just, is this manipulation? Is this to try to present a rosier picture and kind of manipulate the public that things are better than they really are, or is it logical the way you described it as, well, over $100,000, presumably you're not about to spend that, and presumably it's in a CD. So does that really count as liquid cash? I don't know.
Well, you that's what the Fed is saying. It's not liquid cash, and therefore we're not going to count it. And what I'm saying is that under the old definition of M3, which was around 30, 40 years ago, it was considered money because you could get it and you could spend it. It may take you a few days. Fed says that it's no good. It's not a transaction money. It's not M1.
Yeah. And the other thing I would argue about it, though, is if I know I have $100,000 in a CD and I'm down to my last $5,000 to make my monthly payments, I'll feel better about spending that $5,000 just because I know I have that $100,000 of, you can get money out of CDs. You just have to, as you said, it takes a few days. You have to take a little bit of a haircut, but it does give you that psychological boost to spend the money you do have in your pocket.
Yeah, no, but my point is, I don't care whether it's transaction money or investment money. My point is, if it's money, it's there and it's available for investment. It's available for the economy to use, and it's available for stimulating, growth or what have you. So my feeling is, forget this whole transaction money thing and say how much money is available to that. And if take these private equity funds, they go in and buy these businesses, which we talked about a few moments ago. Basically, they are using money which the Fed does not believe is money to do that. So that's why I believe the broader definition is the appropriate definition and not the narrow definition of transaction or not transaction money.
Yeah.
And presumably they use these kind of numbers and stats in trying to direct the future trajectory of interest rates, Dick, and where the economy is headed. The Fed needs these data points immediately.
Yeah, I think the broad money. They need to look at broad money if they want to understand it, because there is theoreticians at the St. Louis Federal Reserve, which used to be the heart and soul of money calculation in the United States, because they had all these PhDs, that worked there that did that. And they say that, money is money based upon what the level of interest rates are. In other words, if interest rates go up, the money supply is not money. And that's where I have a problem. Because if you can use the money to buy a machine, it's money. I don't care what the interest rate is or where the location is, it's money.
We're out of time. We could have talked for a lot longer. It was really interesting, this episode, as all episodes are, of course, needless to say. We'll be back next week when we will talk about how the Fed responded and moved on interest rates this week and what it might mean for the economy and investors. And until then, until episode 88, take care.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.